So far, I have been talking about the concepts and basic knowledge on and on, introduce you the basic situation in the accounting profession and the basic rules we need to follow. And now I just want to introduce you the basic accounting practice and how do we perform accounting, how do we put all the numbers together and generate a meaningful report. In this section, I will define and interpret the accounting equation and each of its components. So right here, we come across with the most important accounting principle, accounting equation, which is total assets equals to total liabilities plus equity. So liabilities is the money you borrowed, and equity is the money of your own. So we are talking about two different methods of collecting money here. And then we collect the money to buy assets. In a very simple case, you just use $20,000 of your own money to buy a car. In that case, your car is an asset, right? You just purchased it. It's under your control. So you have a $20,000 on assets, and you also contribute $20,000 of your own personal equity for the car. So it's a 20,000 here for assets and a 20,000 here for equity. In a different case, you just borrowed $20,000 from a bank and then use that 20,000 to buy a car. Still, you have a 20,000 assets under your control, which is your car, and you also have a liability, which you need to pay back the bank for the loan you borrowed. And if I expand the equity side of the equation, the equity could be further divided into owner's capital, which is the money you put in originally, minus owner's withdrawal. And owner's withdrawal is owner's right that they just put the money, get the money from the company to their own pocket. And the owner can do that after they satisfy their bills for their liability holders. And the other two components would be revenues minus expenses, which would give you net income. So if the company makes money, that's a positive plus. That's contribute to the welfare of the shareholder. So that's a plus for equity. If the company spent money, for example, buy materials, that will be called expenses. And if you use a revenue deducted by expenses, you would get net income. And net income also belongs to shareholders. And here we have some math practice. Let's say for a company called Bose, the assets is $150 and the liability is 30. So what will be the equity here? Under the equation, the equity is 150 minus 30, and that would give you 120. In another case, for a company called Vogue, the liabilities is $100, equity is $300. So what's the value of the total assets? It should be 400. In the next case, so for a company called Tesla, the assets is 200, liability is 800, equity is 120, and now you have owner's capital, owner's withdrawal, revenue, and expenses. So what's the number here? Well, you should know that assets equals to all of this together. So if you add liabilities to equity here, that's 200, and then so the difference between liabilities and equity is equal to total assets. And now you want to know on the equity part, which include these four items. So the summation of the four items should be 120. So 120 equals to 100 plus 0 plus revenues minus $40 of expense. So what that number would be? That should be 60, right? And in the next case, when you expand equity of a 240, it equals to owner's capital of a 220, and you miss owner's withdrawals. You have revenues of 120, and you deduct expenses of a 90. So what would make the summation of the four number equals to 240? So we are solving for owner withdrawal here. Do you have any idea? I think this 120 plus 90 minus 90 would be 30. 30 plus the 220, that would be 250. So from 250 to 240, the owner's withdrawal should be 10. Okay, and that is a negative number. All right, and now let's look at the analysis of business transactions using the accounting equation. So the first transaction, we can call it an event or an activity. Right here it says Chas Taylor invested $30,000 cash to start a business. Okay, so that accounts involves our cash, well, and also Taylor's capital. So basically on the company's financial statements, the cash increase and also Taylor's capital or Taylor's investment as equity increased by the same amount. So it's a $30,000 cash being injected to assets and a $30,000 equity being raised. And you can see that here's assets, here's equity, 30,000, 30,000, they equal to each other. And for each of these event happens, there have to be two items get affected. In this transaction, one item is cash, and another item is owner's capital or equity. So in the accounting equation, Chase just invested the $30,000 to start a business, and you can see that on the asset side, the cash being recorded is a 30,000 increase. On the liabilities and equity side, the equity increased by $30,000. So the total on the both sides of the equation is the 30 and the 30, they equalize to each other. The second transaction, the company purchased supplies paying $2,500 cash. All right, as you can see, when you buy something, your cash would drop, right? And after you purchase supplies, your supply will actually increase. So what happens here is the cash as assets drop by 25,000, and your supplies as assets increase by 25,000. And on the accounting equation, what you'll see there is the change only happens within the assets part. The cash goes down, the supplies goes up. So your assets has changed its form from a partial cash to partial supplies, but the total still holds at $30,000. As you can see, a 2,500 positive, 2,500 negative combined would give a zero effect on your assets level. And on the other side, when you see equity, there's no change at all. There's no owner's withdrawal. There's no owner's additional capital being put in there. So it is still $30,000. The next transaction, the company just purchased equipment for $26,000. Well, you spend $26 cash, and then what you shall see that cash balance got reduced and equipment increases. All right, and they change by the same exact amount. So on this equation, you will see equipment increased by 26,000, but cash got reduced. So after 2 rounds of a deduction, your cash changed from a 30,000 all the way to a 1,500. Because 1,500 is 30,000 minus 2,500 minus 26,000. And then your supplies increased from 0 to 2,500. Your equipment increased from 0 to 26,000. A combination of these 3 types of assets would still give you a 30,000. And on the other side, the equity is still Taylor's capital. He firstly injected into the business, and his well-being, his assets under his control is still this assets of $30,000. It's just a change from $30,000 cash to 3 types of assets altogether. Number 4, the company just purchased supplies of $3,100 on credit. Well, this time the company does not have enough cash, so they have to buy things on credit. So it's like they borrow money from a credit card company, or they just do not pay upfront. Instead, they will pay later. So if the $3,100 supply purchase occurs on credit, then definitely they would increase the level of supplies by 7,100, and also they have to pay a bill of 7,100 in the later period. Right now, we recorded based on the GAAP rule that the expense is recognized when it incurred. So right here, when you spend 7,100, this is recognized. The thing is, it's not paid in cash. So what is changed? What changed is accounts payable. The company has a certain debt to pay in the future. That is a liability, right? You have to pay that bill in the future. Today, you have a liability. So accounts payable is a liability. So on the equation, on the financial statements, you will see that supplies further increased by 7,100, and it now reaches to 9,600. 25 plus 71 is 96. And then on the liability side, this 7,100 is from accounts payable, which you will settle the bill in the future, and that's not part of the owner's equity. This is the company's short-term liability that they will settle in the future. And you can see that the balance sheet actually changes, and the total assets is 71,100 now, and the total liabilities and equity is still the same amount. All right, now let's look at transactions involving revenues, expenses, and withdrawals. So previously what we did was liabilities and equity, and now let's look at this revenue. So the company just provided consulting services to a customer and received $4,200 cash right away. So in this, if this happens, then you will see a cash as assets increases, and also the revenue as equity increases by the same amount, of course. So what you see there is the equity is a part, the revenue is part of the equity. So the equity increased by $4,200 on the right hand side, and on the left hand side, you will see your cash increased by $4,200. So that both change would make your balance sheet increases, and you will see this is a increase of 4,200 from the previous number. So is liabilities and equity side. It increased by the same amount of $4,200. All right, now we have two transactions going on together. You have first, the company paid a rent of $1,000, and also the company paid a salary of $700 to employees. So these are rent expenses and the salary expenses for the company, and this would reduce the owner's equity. So what happens is the company's cash went down, and the rent expenses increases, and the equity would drop. The salary expenses increase, and equity would drop. So if you spend more money, then definitely your holding of the equity would shrink. So remember, the balance in the expense accounts actually increase, but the total equity decrease because expenses reduce equity, or you can say that expenses is a negative equity. So what you see on this balance sheet is that the salary expenses is 700, but the rent expense is 1,000. So when you put them together, that's a $17,000 expenses. And on the left-hand side, you will see your cash got reduced by $17,000, combining the two activities. So that basically makes your whole balance reduced by 1,700 on both sides when expenses is deducted from equity. So that actually make your equity smaller. Transaction 8. The company just provided consulting services of $1,600 and rents facilities for $300 to a customer for credit. Well, there is actually two activities, but it's okay because the company just earned some revenue from two sources. One is the consulting services, and another is rental of their facilities. So the company gets paid in total of $1,900. The thing is, they do not get a $1,900 cash. Instead, they will get a credit. That means they will collect $1,900 someday in the future. But because that revenue is already recognized, we're going to put the number $1,900 in our balance sheet, in our accounting book. It's just not in cash, but it's a credit. So that credit is recorded as account receivable. All right, and account receivable is the assets. So if you have more account receivables, that basically means you have more money to collect in the future, and you're better off. And on the equity side, you just earn revenues from a consulting. You earn revenue from a rental. So when it's revenue, then your equity would increase. If you look at the balance sheet, so what happens here is you have account receivable. Accounts receivable is here, 1900, which is a summation of 1600 and 300. All right, so 1900 receivable, that's part of your assets. It's just not in the form of cash yet. And then on the equity side, you make some revenue here, 1600 plus 300. So both sides would increase by $1,900, and still the equation maintains the same balance for both sides. Transaction 9. A client in Transaction 8 pays $1,900 for consulting services from account receivable. All right, so now your bill is paid. Instead of waiting the client to pay you, you just get paid in cash. So what happens there is your cash increases, but you just do not have that outstanding bill anymore. That bill is gone when your cash is paid. Like somebody borrowed money from you, he or she would write you a note, and when they pay back the money to you, that note should be teared off, should be destroyed. That note should not exist anymore. Likewise, if account receivable is settled, then that account receivable will disappear, so that part of assets would be gone. So your account receivable will be no existence anymore. And then your cash increase. So what happens on the accounting equation here is that account receivable decrease, but the cash increased by the same amount. All right, it's just like your assets transformed from a partial account receivable to partial cash. The total balance is still the same for total assets, and there's nothing changed on the equity and the liabilities part. So you need to remember that when account receivable is paid off, your cash increase, the account receivable would disappear. Transaction number 10. This company just pays $900 as partial payment for supplies purchased in transaction 4. So what we did in transaction 4, do you remember? The company purchased supplies, but they did not pay cash. Instead, they just pay later. Okay, they pay later, and when they purchase the materials, then that is account payable for them that will be paid, settled in the later period. So if eventually the company pays that account payable, so what happens is that the cash actually got reduced because you use the cash to pay the bill, and then your notes payable will disappear. After you pay that bill, that note should be destroyed, should be no longer existing. So what you see on the balance sheet is that cash got reduced by $900, and you also have a $900 decrease for accounts payable. And these both contribute to the deduction of your total assets and deduction of a total liability and equity by the same amount. All right, next transaction. The owner withdraw cash, and this would involve cash assets going down because there's less money, less cash on the company's account, and also owner withdrawal would increase. All right, so the owner has the right to get money out of the company, get the cash out of the company, and put his own pocket. So as a result, the total equity would decrease because there's a withdrawal and there's less money left on the company's balance sheet. So what happens here is that when 200 cash is withdrawn by owner, then the cash got reduced by 200 from 5,000 to 4,800. And then for equity side, when owner has a withdrawal, so that's a negative number on the equity, so negative 200, negative 200, and they both contribute to a $200 deduction on total assets and total liabilities and equity. All right, so that basically was an introduction of a basic accounting equation. And here we have some exercise for you to do. A person just invested $4,000 cash in a Tata company, and then the company purchased 2,000 equipment on credit, and then the company provided services for client on credit, and then the company paid 250 cash for an employee's salary. So what happens here is that for the first transaction, it's a $4,000 cash being injected in the company, and then the $4,000 capital for the owner's equity. In the second one, the company purchased 2,000 equipment on credit, so you will see that equipment actually increased by 2,000 from zero, but the company did not pay the cash. The company instead will pay later. So when that expense is incurred, that would be recorded as account payable, which will be settled in the future. You will see 2,000 here and 2,000 here, they match. The third activity is the company provided $540,000 service to a client, but it's not on cash, it's on credit. So when the revenue is generated, it should be recorded in the balance sheet. The thing is, the company did not get paid in cash of $540. Instead, the company will collect the bill in the future, and that bill amount is $540, and that is recorded as accounts receivable today. The company will receive that money in the future, someday, but not today. Still, account receivable is an asset. So when assets increase, combined with the revenue on the equity side, they both increase by the same amount to the balance sheet. The fourth transaction here is the company paid a $250 cash for employee salary. So this time cash is used. There's a deduction of a $250 from a cash of the company, and on the equity side, there's expense being spent there of a $250. So both contribute to the deduction of the balance sheet. So eventually, if you combine the total assets, it's $3750 cash plus $540 account receivable plus 2,000 equipment. All right, so the total is $6,290, $6,290. And if you look at the liability and equity side, the account payable is at 2,000, so that's the only item for total liabilities. And for equity, which combines four components, 1, 2, 3, 4, and altogether they would add up to 4,290. So if you add this total liabilities to total equity, that would be exactly the same amount as total assets. So far you can see that each item here, each activity, each transaction would result in a change on the assets part and a change on liabilities and equity part. It's not just a change of one single separate item. And the second, when you combine the double changes for each transaction, then the total assets would match the total liabilities and equity.